Hello and good morning from London. My name is Jonathan Buss. I'll be co-hosting today's session. Thank you very much for joining us, by the way. It's our pleasure to welcome you to today's webinar. Just by way of introduction, as I say, my name is Jonathan Buss. I'm an economist here in the Asia Pacific team at Oxford Economics with a particular forecast interest in Japan. I'm also joined here by Gabriel Stein, who is Director of Asset Management Services here at Oxford Economics and a seasoned Japan watcher. He will be talking today about various leading indicators for Japan and what they mean for economic prospects for Japan in 2015. Before we get going, can I please kindly ask you to all keep your buttons in the mute position? And if you have any questions, please do send them through to the host of the meeting, Adrienne, and she will forward them on to us. All right, I'll pass you over to Gabriel.
Thank you very much, John. Good morning from London, everyone, and thank you for taking time to listen into this webinar on Japan. Japan has now been engaged for a couple of years in an experiment which has been dubbed Abenomics. Abenomics is frequently perceived to consist of three arrows: a monetary stimulus, a fiscal stimulus, and a structural reforms package. This is strictly speaking not true. Abenomics actually consists of four arrows: a monetary stimulus, a fiscal stimulus, structural reforms, and fiscal tightening. The problem is that the first two arrows, monetary and fiscal stimulus, were indeed launched by the Abe government in conjunction with the Bank of Japan, and by themselves they have a beneficial short-term impact on the economy. The fourth arrow, the fiscal tightening, was also launched by Mr. Abe and his government, and by itself it has a long-term negative impact on the economy. The problem is that the third arrow, the most important one, structural reforms, which would build on the first two stimuli and enable the economy to overcome the impact of the fiscal tightening for the long-term future, was never launched. Mr. Abe, as we know, took the decision late last year to call a snap election. He won that election very handily, much more handily than expected when he called it. And can certainly claim to have a renewed mandate for these structural reforms. But there are two problems here. The first one is we don't really know if he's going to implement any reforms or even suggest them. The second is, even if he does, structural reforms are usually demand deflationary, and above all, they take time to work. And so meanwhile, we have 2015, where we need to have some handle on what is likely to happen with the Japanese economy. And we're therefore looking at a number of indicators, all of which have the fact in common that they are shorter or longer term leading indicators of activity. Now, the problem with these indicators is, and this is the bottom line, is that most of them seem to be moving at best sideways. And the problem with sideways is that this indicates trend growth, perhaps slightly above trend at best, but it doesn't sound as if it is enough to break Japan's deflationary mindset. And of course, this means that asset prices are unlikely to develop as nicely as they've done in the last couple of years, and it is a downside risk to our Japanese base scenario. Let me start by looking at a couple of survey-based indicators. The two most important business surveys in Japan are the Tankan survey from the Bank of Japan and the Shokochukin Bank Small and Medium-Sized Enterprises survey. The Shokochukin survey, even though it covers both manufacturing and non-manufacturing companies, bears a reasonable relationship with industrial output. As we can see from this chart, the survey has recently turned down. The index is currently, the latest reading for the index is 47.3. This compares with a 5-year average of 46.9, but more importantly, the index has, except a brief period when the hopes of Abenomics were the greatest, barely been above the boom-bust line of 50 for the past 10 years. Recent numbers, as I say, imply a downward trend. Meanwhile, the Tankan Business Survey, which covers all enterprises, again, manufacturing, non-manufacturing, and above all small, medium-sized, and large, has a good relationship with GDP. There are actually two questions in the Tankan. There's the actual business conditions index and the forecast business conditions index. These don't always go as well together as they should. And what is perhaps somewhat worrying is that the forecast business conditions in the first quarter survey is down again, the trend generally down, and unfortunately this seems to fit the weakness of GDP. And finally, having looked at business surveys, looking at consumer surveys, consumer confidence, I think the most positive thing you can say about consumer confidence is that it is more or less on its post-Great Recession average. Latest number is an uptick, disregarding the very latest monthly data, which is always dangerous to hook all your beliefs on. The latest trend is still down, but I will be charitable and say it looks, broadly speaking, as if this index may be moving sideways at a relatively low level. So survey data for domestic demand is not particularly encouraging. Looking at data from the real economy, I always find that term a bit strange because I actually think financial services are as real as others. This is somewhat more varying. The by far most optimistic series we have is car sales. Now, sales of new cars are a key leading indicator of household sentiment in almost any economy. This is because car sales are one of the two biggest ticket items that households normally buy. Usually they need to borrow to buy a new car, and that means that they will want to feel reasonably confident that they can service the borrowing cost. So a surge in new car sales is good news. A slump in new car sales is bad news in terms of near-term consumer spending. On that basis, the latest numbers look extremely good. Car sales are at their highest, were in December, were at their highest level since late 2009. Unfortunately, however, this series may be slightly misleading. It is distorted by the sales tax hike in April last year, which acted on car sales somewhat similar to the very frequent cash for clunkers car trade-in schemes that many countries experiment with. In other words, there was a surge in car sales in early 2014, for that matter actually in late 2013 as well, to beat the April increase in the sales tax. Then there was a slump, and now we are about 9 months down the line and people are saying enough already, I do need a new car, and so car sales have picked up. So I would be tempted to average out really the period over the past year, and what we have then is a somewhat weak but perhaps slightly still trending up series for new car sales. Enough not to feel despondent, not enough to feel wildly optimistic. I mentioned earlier that cars are one of the two biggest ticket items that households buy. The other one, of course, is housing. Japan is in a somewhat peculiar position. On the one hand, its demographics are dreadful. Together with Singapore and Korea, it probably has the worst demographics in East Asia, and just as bad as a number of European countries. For those who have an extremely long investment horizon on current demographic trends, in 500 years there will be 15 Japanese left, not 1,500, not 15,000 or 15 million, 15. However, I think it's safe to say that it's beyond most people's investment horizon and will hopefully not come to pass. However, the falling population does mean a weaker demand for housing. As against that, the number of single-person households is rising as people do not get married or get married later, and that should to some extent counteract the first effect. Nevertheless, looking at this slide, which is on your screen now, what we find is, yes, perhaps since 2008, again, there is a very, very weak uptrend in housing starts in Japan. On the other hand, since 2013, the trend is much more firmly down. And again, for 2015, this implies a weak housing sector. Looking further at the production sector in Japan, a key leading indicator historically has been the amount of overtime worked in manufacturing. This is actually an indicator which is now improving. It is rising erratically. It is still that the number of hours worked overtime is still well below where it was before the Great Recession. It's equally lower than it was about a year ago. Nevertheless, the long-term trend here does seem to be somewhat more decisively upwards. Whether that is in fact partly related to the weak demographics is more difficult to say, but at least it does seem like a positive indicator for the Japanese economy even near term. Sadly, that cannot be said of a perhaps rather more important indicator for the next 3 to 6 months, namely the inventories to shipments ratio. There was a huge jump in the inventories to shipments ratio in 2008. That's not particularly surprising, of course. That was then worked out very quickly, but since 2009 or 10, what we're seeing is in fact that again, with erratic moves around the trend, the inventories to shipments ratio in Japan is picking up. This indicates a build-up of inventories. Some of that may be voluntary, but that's highly doubtful. Most likely much of this is involuntary. And of course, if inventories are rising, it means that near-term output, particularly in manufacturing, is going to weaken as companies try to get rid of unwanted inventories. And perhaps this is also why we are seeing core machinery orders, again admittedly an erratic series, having picked up in 2013, now at best moving sideways. Now, so the leading indicators that we have for Japan so far, both survey-based and from the real economy, imply at best sideways, are best moving sideways, some of them edging down, some of them edging up, and that would point to perhaps a best trend rate growth. Where does that leave us with the key measure, or a key measure? It's perhaps not the key measure, but remember, the point with Abenomics was to finally break Japan's deflationary mindset. Japan has been in deflation, benign and malign, really since 1997. The Bank of Japan has set a target for 2% inflation, and ultimately while much inflation that has been achieved so far has been thanks to the weakness of the yen in the early period of Abenomics, and so it's foreign influences. As it were, the success of Abenomics stands and falls with generating above-trend activity, which ultimately will lead to inflation, and domestically generated inflation at that. Well, just looking at where the numbers are, excluding the impact of the April sales tax hike, core inflation has not reached 2% since mid-2008 and is rapidly headed down towards zero again. Headline inflation has dropped below 2%. And so far, Abenomics must on this measure be judged a failure. What is the outlook? Well, looking at inflation surveys, going back to the Tankan, as we can see, although the numbers vary slightly between companies by size, on no relevant time horizon does Japanese business expect the rate of inflation to actually reach the 2% target. The best that seems to be hoped for is about 1.75% in 5 years' time, and that's only small companies that are as optimistic as that. Let me move on from that. And this is confirmed by the broad money data. As Milton Friedman famously put it, inflation over any sustained period of time is always and everywhere a monetary phenomenon. Looking at broad money developments in Japan, well, M3, the broadest measure of money, its growth has picked up. It is actual in the longer term upward trend since 2005. In 2005, broad money contracted. It's now growing at about 3.5%. That's the good news. The bad news is that its growth rate has slipped over the past year. It did actually reach close to 4%. Now, admittedly, bearing in mind that Japan was previously in deflation, real broad money growth was actually higher in the period 2008 to 2013. Now, with about 1% to 1.5% inflation, we're actually seeing broad money growth at 2%. That's less than would historically be consistent to achieve trend GDP growth. And for those who think credit is important, in my view, as a broad money monetarist, credit is less important than broad money. But nevertheless, we did see a rise in credit from late 2011 onwards, boosted by the hopes of Abenomics, but this has since come down rather sharply, and credit to the non-bank private sector is currently growing at less than 2%, nor does it seem likely to accelerate in the near term. Does that mean that Japan will not achieve 2% inflation? Well, it does seem that way. This is confirmed also by earnings data. It is, of course, possible to have inflation without having earnings growth. Real wages can fall as well as rise. But at the end of the day, for Japan to achieve domestically generated inflation, what we economists call demand pull inflation, as opposed to the cost push, which comes from, let us say, higher commodity prices or a weaker currency, you do need higher domestic spending in Japan, and for that you need stronger earnings. And of course, what we're seeing now is that whereas previously deflation meant that even weakly positive earnings were somewhat better in real terms, the very partial success of Abenomics in at least generating some inflation has meant that real earnings are being eroded. To some extent, of course, this is negated by the lower oil price, but that has other impacts as well. And it must be said that markets do not seem to expect higher inflation in Japan either. one can discuss how much inflation expectation, whether survey-based or market-based, are really relevant. At the end of the day, if you have a credible central bank, then long-term inflation expectations must always be that it will reach its target on the policy-relevant horizon, because otherwise you would expect it to change its policy so as to achieve its target. On the other hand, is the Bank of Japan credible? Well, it hasn't reached its inflation target for so long that it probably isn't. So it is perhaps relevant that neither financial markets nor domestic actors in survey-based data seem to expect inflation likely to reach 2% on any reasonable horizon. Now, what does all this mean for Japanese assets and for growth? Well, Japanese assets have done well over the past few years. The Nikkei has risen by about 80% over the past 2 years. The yield on the 10-year government bond has fallen sharply, one as a result of general optimism, the second obviously as a result of the continued quantitative, nowadays quantitative and qualitative easing, so-called, by the Bank of Japan. However, if growth slips down to or even below trend and the deflationary mindset remains entrenched, we think that at least the equity gains could evaporate. It doesn't help that in the very most recent period we have seen yen strength, of course, which further puts downward pressure on prices. Where does all this leave us for growth? Well, our main scenario is that Japanese growth will be slightly above trend in 2015, but bear in mind that Japanese trend growth is somewhere between 0.5% and 1% on our estimates, so not particularly strong. And the Japanese output gap is large enough so that it will take some time to close it, even with above trend growth. And so what Japan should see is some very modest growth in 2015, perhaps even above trend, but certainly at trend, but it's not going to be enough to really bring about any substantial inflationary pressures. For Prime Minister Abe, this means that the pressure to launch the third arrow of Abenomics, the structural reforms, intensifies, and of course the big question for 2015, is he going to do that? And if he does, then when, what will they contain? And above all, when will be their impact? Issues we will return to in the future. I'm now at your disposal for questions. Thank you very much.
Right, so Gabriel, thank you very much for that. I have a couple of questions for you. Firstly, one impression I get is that a lot of these indicators seem to be pointing in a number of different directions. Could you perhaps summarize the indicators and give us a sort of overall picture, please? Absolutely.
I agree. This is an important question. I'm not surprised that one of our listeners has asked this. It's perhaps difficult to get a general overview, but I would say that looking at the indicators without attempting perhaps at this stage to try to ascribe any greater weight to one than to another, it still seems to me that overall the message is slightly more negative than positive. As I said, our base scenario is for above trend growth, but these indicators, their general trend to me indicates that we should perhaps consider lowering our forecast for Japanese output growth to trend at best in 2015.
Okay, another question, perhaps in response to the pessimistic tone of your presentation. What about QQE? Is this having an impact on Japan?
This is a really important question. This is something that is frequently asked. And of course, the issue of the efficacy of quantitative easing has once again come to the fore with the European Central Bank's decision to move heavily into this. The answer is quantitative easing can be effective, but it depends very much on how it is undertaken. In essence, what the Bank of Japan, and I might add the Federal Reserve, have done, and the ECB seems to be doing, is they're operating with the following mindset. They say, we will buy assets from the banking system. This means that we will give the banks, we will credit the bank's accounts with the central bank. That will swell banks' balance sheets, but banks do not like to have huge amounts of reserves with the central bank, and they will therefore try to expand their balance sheets in other ways by extending credit, so that the reserves that we have created for them will once again shrink to a normal or desired level of their total balance sheet. This is known as the so-called money multiplier, and implies that there is a relationship between the monetary base and broad money. In particular in Japan, Abenomics was the monetary stimulus of Abenomics was clearly about this. It was based on the magical number 2. In 2 years' time, we will double the monetary base to achieve 2% inflation. The problem is that the so-called monetary money multiplier doesn't work. There is no fixed relationship between banks' reserves with the central bank and broad money, and it is broad money that is important for activity and therefore ultimately with inflation. If you look at what the Bank of Japan has done, since 1993 the monetary base has multiplied by a factor of between 6 and 7, yet the overall level of consumer prices, excluding the sales tax hike in April last year, is lower than it was in 1993. So the QQE is actually not working in Japan. It works initially because people believe it's going to have an impact. It does work in pushing down long-term bond yields, of course. But if banks, if the non-bank private sector is not willing to borrow, then banks don't create money by extending credit. And if banks prefer to leave their deposits with the central bank rather than deploy them, for instance, in buying other assets, then there is no impact. If boosting the monetary base worked, why doesn't Japan have 10% inflation today? So the truth is, QQE as intended isn't working. What should the Bank of Japan do instead? Well, there are a number of things they can do. They really could print money and distribute it by helicopter if you want. They could, for instance, buy assets from the non-bank private sector. They could buy anything. They could buy people's shoes if they wanted to, though that's probably a bit meaningless. Or they could buy equities, for instance. Perhaps in the case of Japan, a more powerful impact would be if the Bank of Japan, instead of buying 80 trillion worth of government bonds every year, if you simply monetized the government deficit and the Bank of Japan gave the government 80 trillion yen without getting anything in return, of course, or simply distributed the 80 trillion yen either directly or via the government to each Japanese citizen. In other words, give each inhabitant of Japan, I think, 80 trillion yen, about 120 million inhabitants, so they will get somewhere around 650,000 yen per annum. Perhaps tie this to a specific bank account which diminishes in some fashion if the money isn't spent. Now you could say, well, money is fungible. Wouldn't this simply mean that Japanese households would spend the 650,000 they are given, but they would hold back on other spending? potentially, though the experience and economic theory implies that there would be some of the money some extra money saved, some extra money spent. But if the Bank of Japan made an open-ended commitment and said, we will give everyone 650,000 yen this year, we will repeat it next year and the year after, and if it doesn't work, then they will get 1,000,000 yen, and so on. At some stage, households and companies or households would say, I don't really want to hold all this money in cash. I want to do something with it. And whatever they did would be good for the economy, particularly since Japanese households are not heavily indebted. So they would buy goods or services or assets. And while each individual personal household could adjust their real money balance to achieve a desired position, this is not possible for the collective as a whole, and you would therefore have activity and you would ultimately have inflation. Do I think the Bank of Japan is going to do this? No, I don't think so. It's far too unconventional, but it would be far more efficient and effective than what they have done and what they are planning to do. Do we have any further questions that have come in?
Yes, one more question. On the oil price, so what is the impact of the recent fall in the global oil price on Japan, and isn't this a reason to be more optimistic?
That's a really interesting point and a very valid point. Overall, the fall in the oil price is equivalent to a tax cut and a boost in real wages in oil consumer countries, in oil importer countries, Japan as well. So this would offset some of the weakness in real and nominal earnings growth. The flip side is that the fall in the oil price also exacerbates downward pressures on inflation, and that Japan is so close to deflation that the danger is that it pushes the headline inflation index, not necessarily the core index, but certainly the headline one, into negative territory again, and therefore helps to entrench or returns the deflationary mindset to Japan. And for that reason, even though the lower oil prices should be a powerful boost to Japanese incomes and then therefore spending, some of that will be offset by the threat of renewed deflation, potentially more so than in, say, Western Europe or the United States, where consumer prices on the whole are still edging up.
Okay, thank you, Gabriel. I think that's it for questions. And thank you, everyone, for joining us today. Just to let you know, this session has been recorded. We will send the slides and recording to all of those who are registered with us. Thank you very much. Goodbye.
Thank you very much, everyone, and thank you, Jonathan.